This is your Lead Left podcast for the week of September 2nd. I'm Randy Schwimmer. Welcome back. When it comes to private capital, institutional investors in Italy have an increasing variety of options. Exposure to U.S. private equity, for example. And while specialized strategies have emerged, the focus on established buyout funds is prevailing. Private equity issuance has been particularly active. For the first quarter of 2024, even with economic, geopolitical headwinds and the slowdown of global M&A, 104 transactions were recorded. Per a recent ICLG report, this was the most Italian deal volume since 1988. Italian credit investors have historically been big buyers of fixed income. While current exposure to private debt has been limited, appetite is growing and follows the same path of private equity with some nuances dictated by regulators. For instance, insurance companies are one of the largest investor categories in private debt, even though when it comes to U.S. currency exposure, the accounting and Solvency II implications may add an extra layer of complexity. As an asset class, private credit, here as elsewhere, should benefit from a general rotation to alternatives. Investors look at U.S. private markets with renewed interest. As European private market programs grow and expand, the need for diversification becomes even more critical. This is true even with what now can be defined as a trend of investing locally to support the Italian economy, either with equity or debt. Diversification means adding a goal of greater geographical and sector diversification outside the country. So we have witnessed a tremendous growth of European exposure as Italian investors believed this to be the natural evolution of their domestic allocation. With more familiarity with the asset class, the demand for a U.S. exposure has been increasing, especially among those investors with more advanced private debt programs in place. Wealth managers have also been active in exploring U.S. private opportunities, predominantly within private equity, even though debt has been expanding more rapidly over the last year or so. Product innovation is essential here as wealth managers move towards semi-liquid structures. Conversations with Italian investors last week revealed increasing demand for dedicated U.S. versus European exposure or global exposure, blending both. Currency risk and yield differential between Europe and U.S. were often mentioned as key concerns. Beyond diversification benefits, accessing the U.S. middle market, measured as the third largest GDP in the world, with the appeal of well-developed business service sectors, will lead to more U.S. programs. Broadly speaking, allocation of private debt for Italian institutional investors has been in the low single digits, with some willing to increase to 10%. Our sense today is that, as with other jurisdictions that we visited, private debt in Italy is poised to expand within institutional portfolios for years to come. Reporting from the Milan office at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.